An economy, by definition, is the intersection of two things: supply and demand. Supply would be measured in real estate by the number of homes for sale or inventory, and demand would be most affected by, measured the future impact by interest rates. So let's take a look at those statistics and where they are today. Currently, interest rates are closed about 6.89%, slightly up from last week's 6.66%, well below the 8% of a few months ago, about the same range we've had all year long, between 6 and 7%. It rose above that. There's a lot of talk that maybe it would go from 8 to 9 or 10 in hyperinflation. That didn't happen. So I don't really have a crystal ball. Well, I have a crystal ball. It's actually right there. It just doesn't really work or predict the future. But what I would say is it's hard to tell what the future will be, but based on where we are right now, rates are such that buyers are looking to buy property. I've literally wrote 2 offers in the last couple of days. I have buyers who have money to spend and are looking for return investment or buying a house to live in. So the interest rates are creating good demand. On the inventory side, we're still at record lows. You can take a look at the beginning of the year. It's a small number down here. It is slightly below last year, about 7% below. It is the record low of all time for a non-pandemic year. The only 3 years with less inventory were during the pandemic period. And the current inventory level is about half of what it was during a normal market. So we have very few homes for sale relative to the number of sales in a year. And because of the low homes, prices cannot drop. They can't drop overall across the economy. They can drop in certain cities, but overall in the United States, given the inventory levels, we can't have a housing crash until there's too many homes that for buyers, and that would cause then sellers to cut their price. And we're a long ways from that.